How you doing, guys? This is Ryan. Welcome back to the channel. We have a very special video today. It's in collaboration with my good friend Kevin at Adventures in Us Stock Investing. Kevin has a really cool channel. He walks you through how he builds his portfolio. He has a pretty balanced portfolio of stocks, domestic United States stocks, tech stocks, foreign stocks, and he pretty much goes over the psychology and strategies of an investor. And what he's taught me so far is really how to look at a chart, understand the fundamentals of your company, and when to add to your position. I'll be honest, I always thought as an investor, dollar cost average, buy this month a little bit higher, buy that month a little bit lower, but he's very good about reading the fundamentals as to when to add to those positions. He owns stocks like Facebook, Home Depot, Alibaba, and Disney World, and a lot of other well-known brands. And he also owns some stocks that I didn't know, like Tencent from Asia, and a couple others. He produces high quality content, and I'm now glad to call him a friend. Cheers. So actually what we're doing today is I get the privilege of interviewing Kevin. So we're gonna call Kevin in here and we're gonna ask him a series of questions and try to better understand his positions as an investor. While I get Kevin here on the interview, please just head on over to his channel and make sure to gently tap his subscribe channel button, and then head on back over and we'll jump into it. We're back and we have Kevin here. Kevin, how we doing, buddy?
Not too bad, Ryan. Thanks for having me on the channel.
I have a series of questions for you and we're just gonna jump right into it, okay?
All right, let's do it.
So Kevin, for my viewers here, just overall, please explain, how do you know if a stock is a good stock?
All right, so how do you know if a stock is a good stock? Cue the music. So let's look at a couple basic factors. Now this won't be everything, but it'll give you some information if you should dig deeper into the stock. First off, let's talk about one of the 4 things that I look at, revenues. Let's use a company that everybody is familiar with, Disney. Now with revenue, if the product isn't selling or the service isn't selling, then it's not very valuable to the customers. If there's no value being produced, there is no revenue. So taking a look at this chart, we can see that there's some fluctuations going on with Disney's revenue, which is totally fine. We see peaks here and we see valleys here, but overall the revenue is pretty positive. This is important because we're going to base our analysis on this revenue. Now that we know that revenue grows at a positive rate, we want to see how that trickles down to the other factors. So let's go ahead and dive right into net income. Net income is basically revenue minus expenses. Now with these companies, you always want to see some type of growth. Now if a company makes sales, but the expenses outweigh those sales, then we don't really have a profitable company, do we? Eventually, if this keeps up, the company will go under, and so will your money. We want a strong, sustainable company that continues to grow, and a way we can tell that is using net income. Now, net income is important because it captures 3 different things. Well, actually, it's just a couple of different things. Net income will help us follow the money and where it's being spent. We can see how much the company spends on sales, administration, and marketing. We can see how much they spend on restructuring, construction, and merger acquisitions. And of course, other expenses that may occur. Now what I like to look at here is a good margin between revenue and operating expenses. This essentially will either help or hurt the bottom line. Okay, so let's take a look at Disney's financials here and their income statement. If we take the operating expenses and we divide it by revenue, now we can figure out how much revenue is going towards those expenses. So we take the 2 numbers here, this number and this number, and we divide it with each other, we get 22% or around there. This means that 22% of revenue goes to paying out those expenses so we can try to make profit from it. Now compare that to today. If we take the same calculations and we do it in 2019, we get around 19.9%. This is good. This tells us that Disney is making more revenue, but it's costing them less to make it. Now, a couple of things to take note here. Things that can affect operating income are 1, how much does it cost or the expenses to make that product? And 2, what are they slashing in order to keep those total operating expenses smaller? Now, if the company is finding different ways to keep their expenses low and their products that they sell low while still remaining to give out a good product or service, that's good. Now, if they try to increase this margin by slashing, let's say, administration, the sales team, or the marketing team, that's bad. This is because we want the company to produce more value. We don't want a company to cheat the balance sheets or the income statement. Slashing the sales team, the administration team, the marketing, the development team, anything with payroll could mean the company is struggling. Doing this to lower your expenses is not sustainable. Now, there's a lot more factors. These are just the basics of what I look at to dive deeper into a stock to know if it's good. good. Again, we want net income to rise. Now, depending on how a company does their accounting, net income can be cheated. We don't want to feel cheated. Now, there are two kinds of accounting methods, cash basis and accrual. On a cash basis system, you record when you receive the cash or exchange cash. The other way, you can fib a little bit on the numbers. In this way of accounting, if you make a sale, you're able to record that as cash flow. It's recorded in your accounts receivables. This means you made the sale, but you haven't gotten the cash yet. But because you're using this way of accounting, you're able to say that you made that sale and add it to your revenue, which in turn affects your net income, even though you haven't gotten the cash yet. Ho ho ho, these accounting people are clever. So what's a good strategy against that? It's gonna be cash flow. Now, cash flow is very easy and very transparent. Basically, it means how much cash is coming in and how much cash is leaving the door. That's it. It's pretty black and white. So if you see that net income is growing, but cash flow is not, there's something fishy going on there. Now it's time to look deeper into the financial statements, because now we could be having a problem. This is the cash flow to Disney. That looks gorgeous. Now, we want cash flow to grow because cash flow really does explain, is this company profitable? The reason why we want positive cash flow is because if the company goes into a recession, we want to know that this company can still operate through the recession. Remember guys, a company doesn't go bankrupt because of the amount of debt they have. A company goes bankrupt because they run out of cash. Now, cash flow can also be reinvested into the company or pay out dividends. It can also be used to explore new ventures, Disney streaming service, or acquire new companies and expand their business that way. We want to find a good company that can last forever. We also want this company to have a huge moat. Now, Disney has a pretty huge moat because it's a giant in the media. Now, most of the time their moat can also be that you start your kids with Disney at a very young age, and Disney becomes a part of your childhood. And as you grow up and have those great experiences with Disney, as you become parents, you want to pass that experience down onto your children. And thus that cycle is starting all over again. This is Disney's competitive advantage. Now, on a basic level, that's what I'm kind of looking for on the surface level in order to dig in more. Of course, there's things like ROE, ROA, intrinsic value, and a ton of different other factors. But I'm gonna keep this question and answer short. If you guys want more examples, come on over to the channel and check out Is Facebook a Buy? But Ryan, I hope that helps you and your viewers out. If you guys have any more questions, leave it down in the comments. I'll be creepily lurking around in Ryan's comments just in case. Actually, I'll be camping this week, so I'll get back to you guys. I always answer every single comment.
Okay, cool. Okay, do you have any specific kind of tools that you use to do that?
Yeah, of course. I like to use Morningstar. When I was going through the demonstration for you, you might have noticed I was grabbing numbers from their income statement. Now, this can be used when you're going to Morningstar. Companies are obligated to show you their financial statements if they're a publicly traded company. Now, with this tool, you're able to follow through the money. As soon as the money comes into the company, where's it going? Where are the expenses? How much is going to taxes? How much is in their account receivable? How much is in the accounts payable? How much debt do they owe? And most importantly, how much cash flow does this company have on hand? Now, how much would you pay for this? Absolutely nothing. Now, another tool I like to use is Yahoo Finances. Specifically, I use this tool for their charts. Now, with this tool, we can follow the price of the stock day by day, and we can visually see if this price right here or this price right here is overall a good spot to get into. You're simply gonna go up to this upper right-hand corner and you're gonna type in the ticker symbol. For example, Disney is DIS. Now, when you use technical analysis, that's a totally different ballgame. But I like to use this tool to figure out where the dips are in order to add on more to my positions in, let's say, Disney. Again, this tool is free. The easiest way to find this is to type in the stock that you want and add Yahoo charts to the end of it. For example, if we want Disney, I type in DIS because that's the ticker symbol, Yahoo charts. And it'll bring us to the page that we saw prior. Those are the two main important tools that I use.
Awesome, awesome. All right, so Kevin, so please help me in lamest terms. When is the best time to get into a company? So I want to buy a company. I like a company. I look at their chart. What am I looking for?
That's a good question because there's a variety of techniques that you can use to get into the market and invest. The best time to get in is when your stock crashes, not when the market crashes. Okay, let me explain that because most people are waiting for a crash to get in. This here is the S&P 500, or as most people refer it to as the market. Now this here absolutely is the best time to invest because stocks are low. Buy low, sell high. If you're waiting for the stock market to crash, it doesn't happen too often. The last one was the tech crash, which happened nearly a decade ago, and one before that was a little over a decade ago. And all that time in between, stock prices were going up, and all-time highs were in the 90s, and they were in the 2000s, and we're at all-time highs now. So waiting for the market to crash, not a very lucrative strategy. Time in the market is better than timing the market itself. But what we can do in this instance is wait for a good stock to crash and buy in there. For example, this is a chart of Facebook. We can see that over here, we had a pretty good run up of Facebook. Here's the Cambridge Analytica case that caused the stock to correct itself. Here's slowdown in earnings and a bunch of stuff that happened in October, which caused the stock to really crash. Now, I do use technical analysis and fundamentals hand in hand, tied together. Now this won't promise to get you at the absolute bottom of that stock or the absolute low. Even Warren Buffett can't do that. Now this will get you relatively close. This here is a dip. That's kind of an area that we want to go through. This here is a resistant line. I go through this in one of my videos called When to Buy a Stock. Now, if it goes above that line, it means we buy. Now, if we follow each one of these peaks down, we want to buy at the last lowest peak here. Again, this isn't gonna get you to the bottom, but this is gonna get you relatively close to the end of that crash. Now, I did actually hop in around that area, as you can see in one of my portfolios right here. And Facebook is currently up about 33%. Good job, Facebook. But again, this is one of many strategies that I talked about.
He actually had a very good video about chart reading. I'll link it in the card above. All right, Kevin, thank you so much for coming on my channel. I really appreciate it.
Of course, Ryan, thanks for having me, man.
And if you haven't already, guys, please make sure to go to Kevin's channel, check it out. And now you know why I told you need to subscribe to this channel. He's a very seasoned investor, knows exactly what he's talking about, and I'm happy to call him a friend. Cheers.
Peace out, guys.
And if you guys haven't already, please give this video a thumbs up. Leave a comment down below if you have any questions for me or Kevin. I'm sure Kevin will be in the comment section. And to stay tuned for more of my videos. I post at least one video a week. I got up to 2 videos last week. My goal is one day to have 3. I'm getting there. And this channel is all about documenting my experience to financial freedom. So please come on, join me on that journey. And here's some ducks running around. I'm also making a video for Kevin's channel. So when you subscribe to his channel, make sure to look out for that video. They'll both be released on the same day. So whenever you're seeing this video, his video will be live as well. And as always, thank you so much for watching, and I'll see you in my next one.